Welcome to the first episode of Tutorials with Ike, and on this channel, we're going to be breaking down topics of different courses. So whether business admin, accounting, like every single course, you guys are going to be seeing tutorials here. So if you are new to this channel, make sure you like, subscribe, comment, and share. And let's get right into today's topic. So today's topic is actually under Introduction to Business Finance, and this is week 1. So today we are going to be looking at what business finance is all about, why it is important to study it and everything. So this is just for week 1. So let's get straight into it. Now, business finance is a course you are going to study in various schools. In UPS, you are going to do it in level 200. That's first semester. So it's all about how companies or organizations or individuals get money. So if you are going to start any business, let's assume you want to start a salon or a clothing shop, any business, you need money. So business finance is saying, where did you get the money from? How are you getting it? Are you going to take a loan from someone? Are you going to use your personal savings? Like literally where you are going to get the money from. Anyhow you are going to get it, that's up to you. Now that you've got the money, what are you going to use it for? So it's two things, where you get the money and what you are going to use it for that would profit your business. So if you are going to take a loan from someone, you know that obviously it's a loan, so you are supposed to pay back. So now that you've taken the loan, how do you intend to make the business grow with that loan? What are you going to do? Are you going to hire a lot of people to work in the business? Are you going to hire managers? Are you going to buy maybe machinery or anything? What are you going to use the money for? So that's what business finance is all about. And when it comes to business finance, the person who is usually in charge of finance in any institution, as in the head, is usually the finance manager or the chief finance officer. Yes, basically, he is usually in charge of finance in any organization. When you go to like most organizations. So the finance manager does 4 things. And the first one is investment decisions. So you are going to invest into something. Once you are starting any business, you have to invest. At the beginning, you are not really going to get profit. You have to invest before you get your profit. So the chief finance officer has to make sure that he's able to invest in something that will make the company very profitable. So it could be a land. If let's say you want to start a school, obviously you might have to buy a land. You might have to let them build on their land. You might have to get masons to... There are a lot of things. So those things are what the chief finance officer or the finance manager does. He is able to see the future and see what will be necessary for the business to grow. So that's basically what the chief finance officer does. So he just sees what the company will need in the long run. If it is buildings, anything, then he literally purchases them. So what he purchases for is more like a cost now. So you need to cover it. So it's more like an investment. So in the long run, you are going to, account for it. So yes, the accountants would account for it and everything. So that's the first thing, the investment decision. Now the second one is the financing decisions. So when it comes to the financing decision, it's about how you get money. If now that you've thought of what you are going to invest in, let's say land, capital, workers, skilled labor, or anything. Now the question is, how are you going to get the money to? Because if you want to buy land, it is money you need. So are you going to maybe borrow, or you are going to use your personal savings or anything? However you are going to, he's supposed to make that decision. So for some companies, they go for loans or anything from banks. Then after some time, you go on an agreement with the bank. Then maybe after 2 years, they take some percentage every month or anything. So are you going to borrow, or are you going to sell shares or anything? So the chief finance officer or the finance manager has to do that. Now the third thing is the working capital management. What the chief finance officer does, the working capital management. Now in any organization, once you start the business, almost any organization, you are going to hire workers. And these workers, you need to pay them. So the working capital management deals with how you are going to get enough money. Because you can't hire someone and say that, oh, maybe because the business just started, there is no money. You have to make sure that there is money circulating. There's like liquidity in the business. So how you're able to get money for the daily affairs, whether it's how the company is going to survive, how you're going to pay the workers, if there's something, let's say there's something spoiled, how you're going to get money for it. So it's more like a miscellaneous. What happens in the everyday business, how you're going to account for it. So that's the working capital management. The last thing that the chief finance officer or the finance manager does is the dividend policy. Now, when any large organization makes profit, it is two things. Either they give part of the money to the shareholders, or they keep it in the company for future use. So if you are going to give it to the shareholders, so the shareholders are people who have bought shares in the company. So if you are starting a company, you can just put out shares. That's if it is public. You can put out shares. People will buy shares. So if someone buys, let's say, someone can buy like 200 shares, depending on how much it is. So now that you've made profits, the finance manager will say, oh, should we give some of the money to the shareholders of the company, or you should keep them for future use? So as a finance manager, you're supposed to have that. You should be able to determine which one will be good, because you can't give all to the shareholders. At the end of the day, you need money to work with, because things might come, emergencies and everything. So you have to balance it. So sometimes you can do like 50-50, 60-40, depending on what you think would work well with the business. So that's for the chief finance officer or the finance manager. Now we're going to move on to the goal of a firm. So when it comes to a firm or a business, it is usually divided into two: large organizations and small organizations, or big firms and small firms, or big companies and small companies. So when it comes to big companies, it is usually the goal for big companies to make a lot of money for shareholders, so that the shareholders can become richer. Because for every big company or any large organization, usually there will be shares, because you can't really run a big company on your own. So if, let's say, I'm so rich, I have $1 million or $10 million or anything, I can decide to just invest 2 million into a business. So right now I'm a shareholder. I don't go to the company, I don't do anything. I've just more like invested. I hire managers to work for me and anything. So if the managers are working, they have to make sure that I become richer. Do you get it? They have to make sure that the money comes back to me, because at the end of the day, it is my business. I can sack anyone. So if I realize that the business is not going on well, then it means I can sack them. So the managers know this. They know very well that they are working for someone. They are more like agents. Later on, we'll be moving to like agency problems. So they are more like agents. So the main thing, they have to be thinking about the shareholders. Because if the relationship between the managers and the shareholders is not good, the managers can be sacked at any time. Do you get it? So for big companies, it is important to make sure that the shareholders are literally getting rich. So usually they increase the price over time of the shares, so that the shareholders can become richer. So that's for the big companies. Because when the shareholders become richer, the managers become rich, because the shareholders will decide to maintain the managers rather than hiring new managers. But when it comes to small companies, the main goal of small companies is to make profits. And the reason being that is that for small companies, usually there are no shareholders. Hardly would I start, let's say, a small business or something, and I would say I'm selling shares. No. Usually, if I'm starting the business, it means I'm the manager, I'm the director, like I'm doing all the business functions of it. So usually the goal is to make profit or to maximize profit. Because at the end of the day, when I make profit, it comes to me. Do you get it? So for big companies, the main aim is to make their shareholders richer. And for small companies, the main aim is to maximize profits. But then maximizing profits can sometimes be deceptive. If your sole aim is to maximize profits, it can be sometimes very deceptive. Because if you focus on profit too much, you might forget the needs of the people. And when people realize that you are neglecting the needs, but then you are so selfish about the profit, they might go to other companies. So you need to balance it when it comes to maximizing profit and attending to the needs of the people. And we're going to move on to shareholders' wealth. So if, let's say, MTN or Nestle or any company is selling shares, and let's say they say one share is, let's say, 2 cedis, or let's say just say 1 cedi, and I buy 10 shares, if I want to calculate the shareholders' wealth, I'll just multiply how much the shares is. So the share is 2 cedi and I buy 10. So 2 times 10, meaning my shares in MTN is 20 cedis. Do you get it? So if you're asked to calculate for the shareholders' wealth in any business, what you do is the number of shares times how much the shares, that's the shareholders' wealth. So if I'm buying 1,000 shares and one is 5 cedis, it means my shareholders' wealth is 5,000 cedis. So that's all about shareholders' wealth. It's just how much you are making from a company, depending on the number of shares you decide to buy in a company. That's shareholders' wealth. Now we're going to move on to forms of business organizations. So there are 3 main types or 4 main types, but then for business finances, usually 3 main types of business organizations. The first one is a sole proprietorship. So if I decide to start any business right now, maybe and like anything, maybe I'm selling soap, I'm selling food juice, anything, and I'm doing it on my own. It is called a sole proprietorship. So sole proprietorship is a business owned by just one person, and the keyword is just one person. If I decide to introduce another person, it no more becomes a sole proprietorship. So it transitions from a sole proprietorship to a partnership. We'll look at partnership later on. So yes, that's for sole proprietorship. It's basically a business owned by just one person. Just one person. And when it comes to sole proprietorship, there are advantages and disadvantages. Now, the advantages is that it is easy to start. If right now I want to start making soap or anything, I don't need to tell anyone. I'm the only one doing it. If it's a partnership or we are 2 or 3, someone will say, oh, let's start at this and let's make it 3C. Someone will say, no, 3C is too cheap. Let's make it 4C. Someone will say it. So it brings about, there's a delay in decision making. But then when it comes to sole proprietorship, it is easy to start. I don't need anyone's consent. I don't need to go and tell anyone anything. Like it is flexible and there's not much paperwork. So there's no need to document anything. If it's a partnership, you have to make sure everyone knows about anything. If you want to you can't just make a decision in a partnership. You need to make sure that everyone is fully aware of any decision you want to make. And another advantage of it is that when it comes to taxes, they only tax the person, not the company. So assuming I decide to start a business, let's say I'm making soap, they won't tax the company, they'll tax only me. So the profit I make, they'll tax it on me. You get it? It's not like a corporation where there's double taxation. We'll look at that later on. So when it comes to sole proprietorship, they only tax the person. So you only pay for the personal income tax, that's all. You don't pay for any other tax. That's also an advantage of sole proprietorship. Now let's look at the disadvantages. So the main disadvantage of sole proprietorship is that when the owner dies, the business collapses. If I start a business and I die and I'm the only one running, it means the business collapses. So there have been several instances of schools that have been built by just one person. When the owner dies, then you see that the school is like everything just stops. So that's the main. If it was a partnership, probably when, let's say, the owner dies or one of the owners die, there'll be another person to, usually they have like maybe a next of kin or something. But then when it comes to sole proprietor, when the owner dies, even if someone wants to take over it, if it's not in the law, it is very difficult. So that's like the main disadvantage of it. And then another disadvantage is that it is difficult to get loans from the bank. It is usually very difficult to get loans from the bank because probably they see you as not really experienced. Unlike a corporation where it is more like a company and there are lots of people, it is just one person. So even the collateral will not be a lot. So that's another disadvantage of sole proprietorship. It is difficult to get loans from the bank. Now let's go to the source of income or source of finance, how you can finance a sole proprietorship. So if you are looking forward to like starting a business on your own, where are you going to get money from? Now, the most common way is your personal savings. So you can decide to save from time to time. Maybe if you have the dream of becoming a sole proprietor, you can decide to save your personal income. Maybe you are earning from a business, another business. You can decide to invest it in your own business. Or you can also decide to borrow from friends and family. You can tell your friend, oh, I'm starting a business. Or how much will you need? 2,000. Oh, so when will you give it back? Maybe when the business makes profits on anything. So yes, that's also possible as well. You can decide to borrow from your friends. Then you can also decide to get money from the business. As in, if let's say I start a business and maybe my capital was 2,000 cedis, and then every week I make 1,000 cedis, meaning in 2 weeks I've made the 2,000 cedis. Then in 3 weeks I've made 3,000 cedis, so I have another 1,000 cedis. I can invest it back into the business. So it becomes more like a plowback profit. That's also possible for a sole proprietorship. Now we're going to move on to the next type of business organization, which is partnership. So if I start a business and I feel like maybe it is too hectic, there is too much stress or anything, I can transition from a sole proprietorship to a partnership by introducing a new person. The moment I introduce a new person, it is no more a sole proprietorship. So partnership is a business owned by 2 or more people, but it has to be from 2 to 20. Yes, so a business owned by 2 or more people. So unlike the sole proprietorship where it's just one person, a partnership is 2 or more people. And it is a bit similar to the sole proprietorship, and it has similar advantages and disadvantages. So the first one is it's also easy to start. Unlike a corporation where you have to go through a lot of legal processes, it is easy to start. If I have 2 friends or 3 friends, I can just talk to them that, oh, we are starting. I wouldn't need to really go and do a lot of paperwork. So there's no much paperwork. Even though, yeah, it might be more, it is actually more difficult to start as compared to the sole proprietorship, but it's also easier as compared to a corporation. Because once you're in good terms with the people or your partners, it will be easier to tell them. And the next advantage of it is that there is no, just like the sole proprietorship which we mentioned, there is no separate business tax. So if I'm starting a business with my friends, let's say we are 3, they tax us only our personal income. They don't tax the business and also come and tax us. No. So at the end of the day, we are both going to, or we are all going to be paying personal income tax. They don't tax the business. So it's also an advantage. So you realize that the advantages of the sole proprietorship and the partnership are very similar. They are very, very, very similar. Now let's go to the disadvantages of a partnership. So it's also very similar to the sole proprietorship. Assuming we are 3, let's say me and my 2 friends, we start a business and one person decides to leave, depending on the person's contribution, sometimes it can collapse. Even though it is not very common, but then if the rules are not well structured, or perhaps the person was bringing a very huge contribution, or maybe the person's presence is very crucial in the business could collapse when someone leaves. So when it comes to partnership too, sometimes, usually it's not very structured. Usually it's like, oh, friends, we just decide to do it. You get it. So that's also a disadvantage when it comes to the partnership. Another disadvantage when it comes to the partnership is that all the partners are responsible for the loss or the debt that, the business incurs. So if we start a business and we thought it will go well and everything, but unfortunately, due to 1 or 2 reasons, it doesn't go very well. It means it affects all of us. And the thing is that in a partnership, it's not that like you caused it. You don't say you caused it. It affects all of us. Even if you're not really in support of it, but then you just had to accept it so that there will not be any chaos or anything. You are still responsible for it. You are all fully responsible for the loss or the mess you caused in the company. That's also another disadvantage of partnership. Now, another disadvantage is that it is also difficult to get loans from the bank because it is not usually very structured, unlike a corporation. So sometimes when you're going to the bank and you just tell them that, oh, you had this idea with your friends, they might be a bit skeptical about it. So that's also another disadvantage of partnership. Now let's look at the type of partnership. There are 2 types of partnership. The first one is general partnership and the second one is limited partnership. So when it comes to general partnership, it's like if, let's say, I start a business with my friend and we invest and something happens, it means we are all responsible for it. Even if it is fault or anything, we are all responsible for it. So we are responsible for the success and the loss. Like everyone is responsible. It's like we are at the same level. If I invest 20,000 in it and at the end of the day we lose 40,000, it's not that I invested only 20,000, so I lose only 20. No, we both lose all the money. That's for the general partnership. But when it comes to the limited partnership, if I invest, let's say, 7,000 Ghana cedis, I only lose the 7,000 Ghana cedis if it doesn't really go well or if the investment is not successful. I don't have to incur any other. If my partner makes a mistake by investing, let's say, 100,000 cedis and it doesn't go well, it's not my business. So that one is limited. You only account for what you put in the business. That's for the limited partnership. Now let's look at the source of finance or where you can get money to start a partnership. So just like the sole proprietorship, you can get money from your friends. Maybe I can get money from my dad, another person to his mom. Like, yes, your friends or family, anyone that can, help you with a capital. You can get money from friends. You cannot get money from loans from the bank and everything. You can go to the bank and tell them, if it makes sense to them and they are ready, you can get a lot of money from the bank to help you start the business successfully. Now, the next type of business organization we're going to look at is called a corporation. So a corporation is a legal business that is treated differently from its owners. That's basically what a corporation is in simple terms. So if I want to start a business or anything, I can decide to make it a corporation. So the good thing about a corporation is you only risk what you invest. If you see any business that is a corporation and you invest your money there, and due to some unforeseen circumstances or anything, your money gets stuck there, or they use your money unwisely or anything, you can't sue them individually. You can't say maybe Kofi is the owner of this business, so you are going to sue him. No, you can only sue the company. And because of that, cases in the court can keep very long, because at the end of the day, you are not suing the person. You get it? You're only suing the company, so it can be very dicey. That's an advantage of the corporation. Another advantage too is that it is easier to get money from the bank. If you go to a bank in the name of a corporation, it is easier to get money as compared to the sole proprietorship and the partnership as well. But when it comes to disadvantages, the owners are taxed twice. So even though there are quite a number of good advantages, the owners are actually taxed twice. What that means is that just like the same way you couldn't sue the person, this time you can tax the person twice. So assuming, let's say I have a business, at the end of the day, at the end of the month, I make this amount of money. They will tax you a personal income tax, and they will also tax the company itself. Do you get it? So that's one of the reasons why they don't really sue the company, because at the end of the day, they tax the company. So at the end of the day, they are getting revenue from the company without. So that's it about the corporation. They tax you twice. You tax the personal person, like the owners of the company. You also tax the company itself. Let's move on to the types of corporation. The first type is public corporation. So when it comes to public corporation, anyone can buy shares. Anyone. So let's say MTN or Unilever or anyone they are now starting the company. They can put it up in the stock market that if you are interested, you can buy shares. That's about the public corporation. So anyone is, whether you are a minor, like every single person. But when it comes to the private corporation, only few people can buy shares in the company. So usually they already know the people that will buy the shares when the company is even started. So maybe family members, rich friends they know or something. You can't just go and buy shares like that. No, they don't do it like that. Only selected people are supposed to or can be able to buy shares in that company. So that's it for public and private corporation. So we also have state-owned corporation, and that one is by the government. So the government can also sell shares to the public and anyone can buy. So that's for state-owned corporation. Now, the last thing we're going to be looking at is the agency problem. So the agency problem is, assuming I have a lot of money, let's say £5 million, €7 million, €9 million to this, anything, assuming I have a lot of money. But then I don't really want to stress, or perhaps I have like different businesses, so I can't really take care of the business. What I can do is that I can hire agents. So these agents are more like managers, which you might want to call. So they are more like managers. So these managers are more like acting in my position. So they ensure that the company makes a lot of profit. They ensure that everything is running smoothly and everything. But at the end of the day, I need to get my money back. So if I've invested 2 million into the business, I need to get more than it. So the managers are like the eyes of the company. They do the groundwork. So the shareholders, they just put in their money. They pay the managers and everything. So that's the agency relationship. So agency relationship is a situation where shareholders own a company, but they hire managers to run the daily affairs of the company. That is the agency relationship. Now let's look at why there's a problem when it comes to the agency relationship, which we call the agency problem. So the thing is that, let's say I hire someone to look after my company for me. I'm looking at making profits, making sure that the business goes on well, everything is going on well. But usually the agents or the managers are actually seeing it in a different lens. They are usually looking at making money for themselves. Usually they try to focus on their own interests. So sometimes they might even give wrong accounts of the money in the company. So maybe the money in the company is actually $2 million, but they can say $1.8 million. So they'll keep the $200,000. So that's the agency problem, where there is a distortion between the managers and the shareholders of the company. And when agency problems arise, it leads to something we call agency costs. So agency costs is the money that you spend as a result of fixing the damages caused by the agents. So assuming you realize that your agents or your managers are not really doing their work well, or you realize that they are thinking about their personal interests, they hire people to look after the company so that the managers do their work very properly. So by you hiring these people becomes an extra cost. Apparently, it's not supposed to be. It's not really bringing any revenue to you. So that cost is called the agency costs. And another cost is when managers make decisions that don't benefit the company. So assuming you hire a manager to look after the company and everything, by the end of the day, he is thinking about himself. So as a result of that, he makes some decisions that will favor himself, and in turn, it doesn't favor the company. You've lost something, because at the end of the day, you would have been getting more. But because of his selfish interest, you lose some money. So you also term that as an agency cost. Now let's look at how to manage this agency problem. So if you are in a business and you realize that your managers are not doing the work well, or your agents are not doing the work well, how can you actually resolve that? So the most popular way is using incentives, because incentives really help. Most of the time, the thing is that the shareholders don't pay the managers a lot. Most of the time, they want a lot of money whereas they give the managers just little amounts of money. So what you can do is that you can maybe tell them that, oh, at the end of the year, if you're able to make this amount of money, I'll give you 5% more of the money, including your salary. This kind of motivates them to do better rather than they wanting to think about their own personal interests. So you can use incentives or bonuses. Maybe every month, if you do well, if you are able to reach this target, so you set a target. If you're able to reach this, I'll give you this. If you're able to reach this, so that way it motivates them to work better, and at the end of the day, it benefits both the managers and the company at large. Now, the second one is using control methods. So control methods comes with audits. So you hire people to actually, that's what we talked about previously. So you hire people to actually look over the company. So they ensure that usually they take record of everything. So they ensure that there's no way the managers can steal some of the money or make bad decisions. So they evaluate the decisions the managers make and everything, so that they ensure that the managers perform effectively in their business. So yes, that's basically about the agency relationship, the agency problem, and how to manage the agency problem and everything. So that is all for week 1. Probably next week I'll upload the video for week 2. I'll also be doing other courses like principles of leadership, information systems, and any other course. If you guys have any questions, you can just comment down below and I'll answer all of them. See you in the next video.